So Andrea, in light of everything that's going on now with the pandemic, there are a lot of people out there who may be really hurting for cash, and they may not have done such a good job of saving for these types of emergencies, unfortunately. And so when people look for cash, they might go and actually look to do a loan from their 401k, as opposed to maybe going to their bank or credit union or utilizing their credit cards, which quite frankly could already be maxed out. So if you're considering a 401k loan, or you've already taken a 401k loan, then this short educational video is going to be for you today. Now understand, not every company will allow you to do a 401k loan, but many of them do. So if you're going to do one, I think this short educational video is going to be appropriate in helping you understand the ramifications of doing so. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason we've created these educational videos is to help to make the difficult and confusing retirement process simple.
Absolutely, Andrea, and we do this by utilizing our team of strategic partners ranging from certified financial analysts, certified financial planners, estate attorneys, insurance advisors, and other needed professionals to help us build a comprehensive and holistic roadmap that will let our clients know when, where, and how they might reach their retirement goals.
For specialized strategies on how to maximize your retirement savings, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So Andrea, as I mentioned, with the pandemic that's going on right now, millions upon millions of Americans are really hurting. And unfortunately, for those who haven't saved appropriately, they may think about rating their retirement savings, like their 401k, in order to make ends meet. Now, I have to admit that I'm never a fan of anyone rating their retirement savings in order to get by. But when it is a last resort option, I think it's really important that we educate consumers about the ramifications of taking that type of loan and how it may impact them. Because when you are educated, you are able to make a more informed decision on whether you should take that type of loan or not. So we're going to talk about that in today's short educational video. But before we get into that, there are two rules to retirement income that we always give you. And Andrew, what are those two rules?
Well, rule number one is to never run out of money. And rule number two is to never forget rule number one.
So let's go ahead and dive a little bit deeper into how a 401k loan might work. So let's go ahead and dive into our lesson today, talking about 401k loans and the pros and cons of actually doing those loans. The one thing to make note of course, is that you can usually borrow the lesser of $50,000 or 50% of your vested balance. So for instance, if you only had $50,000 in your 401k, then you can only take out $25,000 of that 401k. Now we know that it was an exception to this rule if your plan allowed it in 2020 with the CARES Act, where you can extract, if you had a COVID situation, you can extract up to $100,000 out of that 401k loan without any penalties or any taxation, and you have the opportunity to pay it back over a 3-year time period. And Congress got together and extended the CARES Act in that regards, in that now they're not just looking at a COVID situation, they're calling it COVID TRA. They're not just looking at the COVID situation, they're calling it a qualified disaster situation. So if you fit the definition of a qualified or being impacted by a qualified disaster area, you can also still take up to $100,000 out of your retirement plan. When it comes to 401k loans and paying them back, they normally give you 5 years to repay that loan with interest. So understand, you're paying that loan back with interest. The thing is, that's different from you paying back a loan from a bank or a credit card. That interest is going to the bank or that credit card company. When you're paying your 401k loan back, you're paying yourself back that interest. Now, when you're looking at your 401k, what's really good about helping you pay this loan back is that they make it systematic. So they're going to deduct from your paycheck, every paycheck period, and they're going to do that until that balance is paid off. But understand, this is going to be on top of your regular contribution. So you have to really know that when you're taking out these loans, if you can afford it or not. Here's another caveat to a 401k loan. Now, if you lose your job or if you leave your job, if repayment is required, you will have until the tax filing date of the following year or the extensions as well to pay that loan back. Now, the old rule used to be 60 days, but it was amended by the Tax Cuts and Jobs Act of 2017. So it used to be a time that when you left your job and you had a 401k loan balance, or you were fired from that job, you had 60 days to pay it back. Now you have until the following tax filing year or the extension time to pay that loan back. So let's give a quick example of how that may work. Let's just say you borrowed funds from your 401k in 2020 and you lose your job, or you actually quit and go to another job and you had a loan outstanding. Well, that loan wouldn't be required to be paid until April 15th of 2021 or October 15th, the extension of 2021. So let's say you took a loan out, you took funds out in January of 2021 and you lose your job. Well, that loan would not be required to be repaid until April 15th of 2022 or October 15th of 2022. So I hope that the example gave you some clarity on how that might work. So now let's cover some of the pros and cons of actually doing a 401k loan. One of the things that you might look at is that the application process is relatively simple versus taking out a bank loan or going to a credit union to get a loan, a personal loan. You can usually do a 401k loan online. So you don't have to have perfect credit. You don't have to have any type of credit when it comes to doing an application for a 401k loan. So some people like the simplicity of just taking out that loan without a hassle. Also, the interest rate that you would be paying yourself back when it comes to a 401k loan versus a bank or another lender or credit card could be advantageous to you as well. This is one of the positive aspects of taking a 401k loan, that the interest rate that you would be paying yourself back is typically much lower than that of a bank or any type of other lender. Also, you have no income tax or early withdrawal penalty for taking that money out if you're under the age of 59 and a half. Another positive aspect of taking a 401k loan as opposed to a distribution. The down market effect. This is really unique because this is a two-way street. If the markets are down when you actually have taken that loan out, well, your funds are going to be positively impacted because they were taken out of that 401k and they were out of the market downturn. But that is a two-way street, and we're going to talk about that as we explore the negative aspects of taking out this loan or the cons of doing so. One of the things you really want to talk to your plan administrator about is what are the real fees of taking out this loan on top of the interest, because there are going to be maybe other fees involved in doing this, and the fees can increase the total cost of that 401k loan. Also, we talk about opportunity cost now. So what if you take that loan out and the market is rising? And that's why I'm never a fan unless it's absolutely the last resort of anyone taking money out of their retirement savings, simply because that money is not left inside of those plans in order to work for your favor on the back end of your retirement. So you have that opportunity cost that could be really costly if you're in a rising market and those funds are out of that market, not able to participate in that rising market. Also, when you're paying that loan back, as I mentioned before, you're paying that back on top of your regular contributions, and you're paying that back with after-tax dollars as well. And we're going to talk about the effects of that on the interest that you're paying back. But you're paying that loan back on top of your contributions, so you have to see, can you afford to do that? And also, if you default on that loan, it could be very costly to you because all of that money then will become taxed at your ordinary income tax bracket and could push you in a higher income tax bracket. And if you're under the age of 59 and a half, you would be assessed that 10% early withdrawal penalty, which you definitely would want to avoid. So there is this other thing known as double taxation when it comes to a 401k loan. And there are a lot of conversations around this particular topic. So we dedicated a whole slide to just this particular concept alone. So we're going to go over that in just a moment. But when you're talking about double taxation, the idea behind this is that when you take out a loan from that 401k, you got to pay that loan back with after-tax dollars. And then when you take that money out again during your retirement years, that money will then again be taxed as well. But when you're talking about this concept, what many people fail to realize is that it really only applies to the interest only. So we're going to take a look at this simple illustration here when it comes to taking out a loan and how that would be taxed. So let's just say you took out a $20,000 loan on that 401k and it was at 4% interest. Well, that's going to be $800 that you're going to be paying back as interest on that particular loan. And if you're in a 22% tax bracket, that's going to amount to $176 of taxes that you will be paying when it comes to the double taxation on that particular amount of dollars. So it's not really significant, but what's really important is that we're not talking about the $20,000 being taxed. So let me go ahead and use this example to bring this home even better. So we're going to look at a very simple example here. To me, when we're educating people about their money and about what they should be doing for retirement, to me, keeping it simple is always the best case here. So we're not going to, put in any bells and whistles. We're going to make this really simple so you can understand how this might work. Just say you have a person making $50,000 a year, and they're going to be putting $15,000, or a good saver, $15,000 into their 401k in the 22% tax bracket. We're going to say they have nothing in their checking account starting out. So in year one, they're going to make their $50,000 minus $15,000. So now their 401k balance is $15,000. And if we're considering a 22% tax bracket, they're going to be paying 22% not on the $50,000. This is the thing about putting money into a 401k. You get a chance to get a tax break on that income. You're only going to be paying 22% on $35,000. And at 22%, you're going to be paying taxes of $7,700. And the money that's going to go into your checking account is going to be the $35,000 of income minus the taxes, which is going to give you $27,300. Now, look, we know you have bills and expenses, but we're not going to incorporate that in this example because it's going to help us understand the clarity of a 401k loan and the double taxation of that particular loan. Let's say in year two, now you want to buy a car. That car is going to be worth $15,000. You had your $50,000 of income. You also had $15,000 that went into your 401k. Now it's at $30,000. You pay taxes on the same amount of money. And now because you had $27,300 times 2 going into the checking account, we're going to use this money now of $15,000 to buy our car. And it's going to leave us with $39,600. There we have it. So this is just using your own money, your own cash money after tax dollars in paying for that car. So in our second example here, we're going to now look at using our 401k loan as opposed to using our own cash out of our checking account. Everything is exactly the same. As you can see, same amount of money going into the 401k, the same amount of money being taxed. We have the same amount of cash that we're putting into our checking account. And in year two, we're going to buy a car. It's going to be for the same exact amount. But here's the difference. Now we're going to take a loan from that 401k that we had $30,000 in. Take that $15,000 as a loan and leave it $15,000 in the 401k. Going to pay the same amount of tax dollars, and we have that $54,600 still sitting here. And you may be asking yourself, okay, you have cash, you can do the exact same thing. For this example here, what we're trying to make the point is that if people usually have cash, they're not going to have to take a loan. We want to show you the difference in how this money is taxed. But usually people are in a crunch, they're in a bind, and they don't have the cash in order to do the things they want to do, or they may have this money earmarked for something different, and they feel like this is a very efficient, quick way to take a loan to buy something that they want without having any taxes paid on it or having any penalties. So they may decide to take a 401k loan. But what I want to bring home is the ramifications of the double taxation notion that a lot of people hold out there. So we're taking this money out, and we're going to now have to do a loan repayment back into the 401k. So where's this money going to come from? Well, it's going to come again from after-tax dollars, whether you're paying it back periodically or from your own savings. Let's just say you take it from the savings, you have it, and you want to pay that loan back now that you've bought the car. Guess what? It's going to take you down to the exact same amount of $39,600. You've used after-tax dollars. This money was not taxed when it came out, but you used after-tax dollars to pay it back. And so now you put the money back in the 401k. You have $30,000 in the 401k. You have $30,000 in this example as well. And obviously, in both scenarios, you had to use after-tax dollars to pay it back. As I mentioned, the interest is the double taxation notion, not the principal balance. Anytime that you're looking to do any of these type of loans, as I mentioned, we're going to always tell you to consult with your own financial advisor or tax advisor to see the implications that it may have for you. So I hope that this short educational video gave you some insight into how a 401k loan may work and whether you should think a little bit hard about doing one or not. Please remember that these videos are created for educational purposes only, and always consult with a financial advisor or a tax advisor about your personal situation. For more information about this topic and any of the other topics that we've discussed in our other videos, feel free to reach out to our office and also leave any comments or questions in the section below.
To learn more about our services and how we can help you to increase your chances of not outliving your retirement savings, make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.